Hi there, and welcome back to Clarkenomics. In this video, we're going to talk about a pretty unpopular topic. We're going to talk about taxes. So, nobody likes paying taxes, but of course, as we remember from the mixed economy circular flow model, they do play a very important role in our society by correcting for market failures. So let's go into it with that attitude and not be so angry about taxes, although it's tough. So, who do we have to thank for taxes? Well, a couple of different things. First, the 16th Amendment to the U.S. Constitution, which was ratified in 1913. Now, the reason I bring this up is because in the U.S. Constitution, when it was written, income taxes were actually forbidden. The government and state governments, I think, were not allowed to pass income taxes on people's income. Before the 16th Amendment, which changed that, most of the government's tax revenue came from tariffs, and tariffs are taxes on goods coming in from other countries. So tariffs were okay. In fact, they're how the government got most of its money. But by 1913, they realized that the government was not earning as much tax revenue as it wanted to. So they passed the 16th Amendment, which basically legalized an income tax. And they've been taxing our income ever since for about 107 joyful years now. Now remember, who actually creates taxes? Well, that is fiscal policymakers, the people who craft the federal budget. So that is the U.S. Congress, the Senate and House of Representatives, and the executive branch, meaning the White House. Now, there's another entity you might have heard of that has to do with taxes. You might have heard of the IRS, the Internal Revenue Service. The IRS just collects tax money. They're not the ones who create the taxes. Again, that's Congress and the president who create taxes. The IRS is just the unfortunate entity that is tasked with collecting that money. So we're going to keep our discussion going here with something called tax brackets. Before we get into the specifics of like how to do your taxes, we're going to talk about some, just general concepts of how taxes work. So everybody who earns income has what's called a taxable income. And that is how much of the money you earned is subject to taxation. Believe it or not, the government doesn't actually tax every single dollar that you earn, just some of them. So how much of your income is taxable, right? That's what that term means. Second, tax rate. That is the percentage of each dollar of taxable income that you pay in taxes, right? So if you earn $1 and that's a taxable dollar, what percentage of that dollar does the government take in taxes and how much do they let you keep as a percentage? Next, tax brackets. We're going to talk about this at length, but basically different portions of your income, of your taxable income, get taxed at different rates. So the very first dollar you earn that's taxable actually gets taxed at a different rate than the very last taxable dollar that you earn. Sounds kind of confusing, but we're going to go through it. So there are three basic types of income tax systems. There's what's called a proportional tax, or sometimes people call it a flat tax, where every single dollar of your income gets taxed at the same rate. That would be like every dollar you earn that's taxable gets taxed at 20%, whether it's your millionth dollar or whether it's your first dollar. That's a proportional tax, a flat tax. Then you've got progressive taxes. Progressive means that higher tax brackets get taxed at a higher rate. So like the millionth dollar you earn might get taxed at a higher percentage than the first dollar that you earn that's taxable. And then finally, we've got regressive taxes, which is when your lower tax brackets get taxed at a higher rate. So the millionth dollar that you earn gets taxed at a lower rate than the first taxable dollar that you earn. Again, just from this description, it might be a little bit confusing. We're going to go through some examples that'll hopefully make this a lot clearer. So, let's look at some actual information here from the year 2020. So they update the tax brackets every single year due to inflation, and these are the most recent ones that we have. So we're going to go through an example here where I'm going to tell you what my taxable income is, and then we're going to see based on this tax table right here, how much money would I actually owe in taxes. So let's imagine that my taxable income is $75,000. Okay. This is the tax table for the year 2020, and we'll go through this piece by piece. But here's what some people do who don't really understand how this works. They'll say, okay, taxable income is $75,000. $75,000 is here, right, between $40,000 and $85,000. So I guess I need to multiply $75,000 by 22%. No, that is not how tax brackets work. Here's how it does work. Here's what we need to do. All right. So taxable income over $0. So starting with the first dollar that you earn up to $9,875, those dollars get taxed at a rate of 10%. So what you need to do is you need to take the bigger number, 9,875, subtract the smaller number, 0, and that's going to tell you how many dollars that you earned fell into this tax bracket right here. So that's $9,875 multiplied by 10%, right there, 10%, means that those first $9,875, you owe $987.50 in taxes. Okay. Next, we need to figure out how much money is going to get taxed at 12%. So we need to figure out how many dollars fall between this number and this number. So we would do 40,125 minus 9,875, and then we'll multiply that by this tax rate right here, 0.12, and that means of that slice of your income, of those dollars, you owe 3,630 in taxes. And finally, we're going to stick with your income right here, $75,000 minus 40,125, and those dollars will get taxed at this rate right here, 22%. And so on that slice of your income, you owe $7,672.50 in taxes. Now, these bands up here, we're not really messing with these because, again, my income, that only applies to amounts over this right here. So essentially, if we add all that up, $987.50 plus $3,630 plus $7,672.50, that means in total, I'm going to owe $12,290 in taxes. So what is my effective tax rate? Again, it's not 22%, right? My effective tax rate is simply the amount I owe in taxes, which is $12,290, divided by my taxable income, which is $75,000. So my effective tax rate here, which I've just put the numbers in, is 16.39%. So the effective tax rate is like one of the most important things to look at. This is the actual percentage of your taxable income that you owe in taxes. Now, if what I just did above made sense to you, that's great. But if it was confusing, I completely understand. So I came up with another way to illustrate this. So same tax table as before from the year 2020. And we've got $75,000, which is my taxable income. So what we need to do is we need to break that up into brackets, essentially, right? We know that the first $9,875 are going to get taxed at one rate. The next slice of my income between $9,875 and $40,125 is going to get taxed at another rate. How much money is that? That's $30,250. That's the next slice of my income that's going to get taxed at a different rate. And then finally, the last $34,875 are going to get taxed at this rate. Everything's color-coded, so it all matches up. So that first $987,000, $9,875 is going to get taxed at 10%, right? The next slice of my income, the distance between these two numbers, is going to get taxed at 12%. And the highest slice of my $75,000 taxable income is going to get taxed at a rate of 22%. So you start essentially with a box the entire size of your taxable income, and you break it up into these slices that are each going to get taxed at a different rate. So 10% of this amount is right there, 12% of this amount is here, and 22% of this amount is right there. These are the numbers that we had on the previous slide. If you add them up, you will get 12,290, which, as we determined in the previous slide, is the total amount of tax money owed. So if you're given a tax table, what you have to do is you have to apply these numbers over here and slice the income up into these boxes and multiply each by the percentage tax rate. And then add those numbers up and you'll get the total amount of tax owed. All right. Other types of taxes. It's not just about income tax. There's something called the Federal Insurance Contribution Act, FICA, FICA. And essentially, this is a tax that everybody pays, and it's 7.65% of your income. So if you're an employee, you are paying this out of your paychecks, essentially. And this has two components to it. Everybody pays this, pretty much. First, there's what's called the Social Security tax, which is officially called the OASDI, which is the Old Age Survivor Disability Insurance, I believe. And that is 6.2% of your paycheck. That's paid by both employees, 6.2%, and your employer also pays 6.2%. So you split that right down the middle. And the second part of that is what's called Medicare tax, and that is 1.45% of your paycheck. So when you get paid a paycheck, 7.65% of it is going to the Federal Insurance Contribution Act, essentially, to fund these programs, which we'll learn about later. So there's that. Another type of tax is called excise taxes. Excise taxes you've already learned about if you were watching my videos about microeconomics. These are taxes on specific things such as cigarettes or gasoline, right? Excise taxes on something specific. Next, there is something called the estate tax. This is sometimes derogatively referred to as the death tax. So essentially, when you die, you can pass on your belongings to your heirs, right? Whether it's a house or whether it's, your money. And some of that might be subject to a tax to the government. And a lot of the people who are against this would like you to believe that every dollar you try to pass on to your survivors is taxable. In real life, the only things that get taxed through the estate tax are on estates worth $11.58 million or more. So if you're passing on an estate worth less than that to your heirs, it's not going to be subject to tax at all. Only after $11.5 million is the government going to start taxing that. And the government does that essentially to try to make sure that generational wealth doesn't completely dominate the American economy, right? That wealth isn't hoarded generation after generation after generation, and that we retain some kind of social mobility where it's not just the rich endlessly in control of things. Again, if you're somebody who is against the estate tax, you think that, well, it's your money, and when you die, you want to pass it on to who you want to pass it on to, so the government shouldn't really have a hand in that. But again, for the vast majority of people, this doesn't really apply to them because the vast majority of people are not passing on an estate worth over $11.5 million. This is really a tax on the wealthy that they're constantly fighting against. Finally, there is the gift tax. The gift tax was created to close a loophole, right? So if you know you're about to die and you don't want to have to pay the death tax, well, you would just give all of your belongings to your heirs while you were still alive, right? As a gift. So to close that loophole, the government created a gift tax, which is if you give somebody a gift, and it doesn't have to just be money, it can be an object with a value, the government will charge taxes on that. However, again, this is not just like, oh, I need to get a couple $100 from my mom for tuition next semester. No, it's gifts only over $15,000 annually, I believe. And so this only applies to very large gifts. So these are some of the taxes that the government has. This is not an extensive list. There are many other things that the government does tax. Again, things like sales, taxes on businesses. There's lots of other ones, but these are some ones that you may or may not hear about or may or may not encounter in your own lives. Thank you for watching.